Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures continue to push higher this morning on the back of strong results from Meta and Microsoft. The social media giant beat first quarter revenue estimates and signaled it's well positioned to navigate macroeconomic uncertainty. Meantime, Microsoft shares jumping on the strong quarterly cloud growth, with sales and profit beating estimates.
Now investors are looking ahead to results from Amazon and Apple. For Apple, analysts and investors will be looking for any insights on the future impact of tariffs and the company's ongoing efforts to catch up in AI. Amazon results will also offer some insight into the health of the consumer as well as the company's push into the cloud.
And taking a look at Tesla, the company denying reports that the company's board opened a search to find a new CEO. Tesla's chair said the board is highly confident in Musk's ability to continue executing on its, quote, exciting growth plan ahead. Tesla's vehicle sales and stock price have slumped this year, as Musk has devoted significant time to working for President Donald Trump. While the CEO reassured some investors last week, saying he'll allocate far more of his time to the car maker, others are concerned he's doing lasting damage to the company's brand. Meta shares popping today after topping first quarter expectations, boosted by resilient ad sales, helping to ease some concerns about the impact of the global trade war. CEO Mark Zuckerberg saying the tech giant is, quote, well positioned to navigate the macroeconomic uncertainty. Joining us now with more, Brad Erickson, RBC Capital Markets equity analyst. Brad, great to have you on this morning. Let's talk about that ad revenue here, that 20% ad revenue growth. At the end of the day, this is a company that lives and dies by its ad revenue. Is that kind of growth sustainable?
Yeah, thanks for having me. I would say you're probably going to see some deceleration through the year, but again, off of 19% growth, constant currency, like that's we can live with that. Those are still really, really good numbers, significantly ahead of peers. Google search on a comparable basis only grew 12%, which is also good, but clearly not 19. So yeah, we I think the ability to underwrite at least kind of mid-teens growth sustainably. You've got AI as kind of this persistent multi-year driver. I think everybody's going to be really pleased with that.
What are your anticipations around the monetization of that multi-year driver, Brad?
Yeah, so I think, there's a few things going on that they talked about last night and have talked about for really now for over a couple of years, which is they're improving content recommendation. That's actively being driven by AI. They've improved their ad targeting and ranking engine. So that's helping. And then last night, they talked about things like improving ad performance for the same level of compute. So now you're getting ad performance improvements as well as saving on the cost. Now, for today, that doesn't exactly foot with the CapEx increase. So that's another story. But again, bigger picture, the fact that they can improve the business and also improve that compute efficiency, it bodes really well over the next few years.
Of the tools that you see them kind of implementing as well and really touting those to end users on the platforms, whether that be on Instagram or whether that be on WhatsApp, I mean, it seems like for at least the messenger platforms, they're making a really good use case for a lot of companies, entities that would be advertising and can push some advertising within even the messenger realms that Facebook or Meta platforms more broadly offers.
That's right. Yeah, it's a little interesting. There's kind of a bifurcation geographically here. In Asia and particularly in places like Latin America, also in Europe, people are much more familiar with some of these super app type platforms, whether it's WeChat, WhatsApp, et cetera. And so they're kind of more comfortable aggregating a lot of different kinds of services and interactions with different kinds of businesses within one app. And like you said, that a lot of that interaction tends to be messaging, and they are able to monetize those ads. In the United States, we're more kind of an app user base. And so we like to kind of keep apps sort of separate on our phones. And Apple, for what it's worth, doesn't even allow super apps on its iOS app store. And so I think, they're having to take a little bit different approach. This is what they're doing with Meta AI. So that part of the business hasn't really taken off yet. But again, I think to the degree that they can cater towards that kind of app by app usage, I do think that is a big opportunity. And like you said, interacting with businesses, getting that opportunity to get in front of more customers where there's relevance and intent, that's super powerful for driving ad revenues over time.
Yeah, let's talk about that CapEx on AI as well. $72 billion for the course of this year. But as you know, their LLM from Meta is kind of a distant fifth in terms of comparison with the other LLMs out there. Can Meta transition to being the winner on AI with CapEx like that?
Yeah, I think, there's kind of a couple different ways to win, I guess, in the context of the question. You are right. From a developer perspective, Llama is behind clearly, and yeah, I think fifth is the right number. So, but I think in this case, the goal of Llama is not solely to sort of drive developer interest on the end enterprise use case. I would say a bigger piece of it is getting developers to contribute to it such that Meta can then take that technology, internalize it, and drive ad revenues, right? So like that's the consumer side of winning. I agree the enterprise is slower going at this point, but you look at this ad growth, you look at the durability of how they're improving conversions and making the ad platform better, building out surfaces. Basically, we say it, finding ways to take up more of people's day. That part of it, we absolutely do think they're winning and can continue to.
And I just got to get your take on that CapEx number. You put something in your notes over to us about that being a nitpick for you in the earnings print. Talk to me about that.
If it's possible to nitpick, it's 72 billion. Yeah, there's two ways to spin it, and we probably come out more positively, but certainly the negative argument is valid as well. The positive argument is they're feeling really good about revenue growth. This is a moment where investors are going to give them leash to take that number up, and they're doing it. That's good. On the negative side, I think they definitely did call out one of the primary drivers there is equipment and component costs for this infrastructure, i.e. things like GPUs and servers and networking equipment. All of that pricing is going up. So you can kind of make the argument that structurally return on invested capital for this space may have actually declined versus 90 days ago. That's not great. Now, at a moment like today, where you're beating revenue estimates, that's okay. We can handle that. But you got to keep doing that in that kind of rising cost environment.
Brad, just lastly, we only got about 30 seconds here. Just wanted to get your initial review. They launched the new standalone AI app. Trustworthiness is clearly going to be key for a lot of these new app features that get rolled out by tech companies. Where does Meta sit within that?
Yeah, I mean, privacy's always been an issue. Whether it's your Instagram account, Facebook, Messenger, anything you use, WhatsApp, they're watching and they're collecting all that data. So I don't think that changes. So at this point, I think it's hard to say there's going to be some structural change with Meta AI. So I think, status quo for the moment, based on the little we know.
All right, Brad, thanks so much for taking the time here with us, breaking down some of the Meta earnings. Good to see you. Microsoft surging after beating fiscal third quarter expectations fueled by strong cloud growth. Steady demand for the software giant's cloud services, a welcome sign for investors amid President Trump's tariffs and economic uncertainty. Joining us now, we've got Brent Bracelin, who is the Piper Sandler equity research analyst. Great to have you here with us this morning. How are you really sifting through Microsoft's results right now, and for the company trying to maintain cloud dominance and win that battle for cloud dominance, where do they stand in that effort?
Sure. Thanks for having me, Brad, here. Yeah, really impressive numbers out of Microsoft, just given the current environment and backdrop, really showcases how diversified and resilient this business model is. But let's be clear, this story really is all about cloud and AI. And that's really what surprised us the most. You actually saw an acceleration in their Azure business. And to put things into perspective, Azure is approaching $80 billion run rate, growing 35% year over year. If this was a standalone business, this would be the fastest growing software infrastructure company in the entire space. So really impressive growth out of the Microsoft Cloud and AI business.
And to what extent does that success justify the CapEx on AI?
Yeah, that's tricky, right? You're talking about a company that is aggressively investing in CapEx. They'll spend $86 billion this year. Investor scrutiny is certainly increasing relative to is there an overbuild or not. What is interesting is it does look like CapEx on a year-over-year basis peaked last quarter at 97%. It still grew over 50% this quarter, but now you're talking about growth in CapEx slowing to less than 20% in Q4, and we think it'll grow only in the low teens next year, which implies now you're starting to see monetization of the cloud and AI growth faster than CapEx. So yes, we've had a 2-year investment. A lot of that investment has been around real estate, power contracts, concrete buildings. Those are long-lived assets. Over half, we estimate about $70 billion of the spend for Microsoft over the last 2 years has been in those long-lived assets. We're now going to see the composition of what they spend CapEx going forward more tied to intra-quarter demand signals around GPUs and CPU capacity and storage and networking. And I think a lot of the upfront investment around CapEx tied to long-lived assets, that should start to moderate. So we think the most important metric here, cloud and AI, we think will start to grow faster than the CapEx spend.
And
really important.
Yeah, sorry, didn't mean to cut you off. And it is actually, to your point, they did talk about that on the call, talking about the moderation in that capital expenditure growth rate here. And that also gets us into the conversation around what realistic margins investors should be expecting on a longer run rate, especially as we do see some moderation lower, perhaps in the capital expenditure growth rate. It seems like the figure that they're tossing around or thinking about is 67% Microsoft Cloud gross margin. So how does that translate into continued growth for the rest of the business as well?
Sure. And as we take a longer term perspective here around the margin profile, Microsoft in the past has not been afraid of building a large, sizable, new incremental business at slightly lower gross margins. You saw that in cloud, right? So the overall gross margin for Microsoft pre-cloud, we're going back 15 years, was actually higher. And you saw them build a $100 billion cloud business and a lower gross margin. More importantly, and so yes, we think as they build this AI business today that is north of 15 billion, as that potentially gets to a $100 billion business, that will be a drag on gross margins. But this portfolio that Microsoft has built is really driving outsized operating margins. So even at a lower gross margin over time, we think Microsoft can maintain 40% plus operating margins. This is really best in class in the tech space. And yes, it will come at a slightly lower gross margin, but it's really the operating margin driving over 130 billion of operating cash flow this year. That's the key metric that we're paying attention to. And again, they have a proven track record. They added $100 billion plus cloud business in the last 15 years, lower gross margin, but still is able to drive meaningful operating profit margins for the company and operating cash flow.
You know, it's interesting, Brent, thinking through some of the important partnerships, strategic partnerships that Microsoft has been able to net. One of them that really comes to mind for investors of both of these companies, and I know Palantir is not within your coverage directly, but when you think about some of these strategic partnerships that come forward, what is the net add there? What's the win for Microsoft that they would potentially get out of this, especially as it seems like even amid some of the geopolitical tensions, cybersecurity is not an area that companies are willing to cut or trim their spending around right now?
Yeah, so I'll remind you that Microsoft has a $20 billion security business. It is part of their M365 portfolio, and they're seeing good momentum, good adoption there. But as you take a step back and look at partnerships and strategic partnerships, the reality is that this is an infrastructure platform. The cloud business is now 169 billion, almost 170 billion, growing 20% overall. A big part of that is obviously Azure, which is a platform that a lot of application companies build on top of. So Microsoft is a strategic platform for a lot of applications. Could be in the security space, it could be in the enterprise space. They do have a business apps business, Dynamics 365, but that's about 3% of revenue. So there's a tremendous opportunity for Microsoft to continue to partner, particularly in the app space across multiple companies. They have actually over 60,000 enterprises that are building apps on top of Azure. So really good strategic position. And we would expect them to continue to partner with a lot of these application companies.
All right, Brent, thank you so much.
Thank you.
Some breaking news crossing the wire. Retailer Kohls out announcing the termination of its CEO, Ashley Buchanan. Shares were briefly halted for volatility this morning amid the announcement. The company saying the CEO violated company policies amid an investigation that was conducted by an outside counsel. The board will now initiate a search to identify a permanent CEO. Michael Bender will take over as the interim CEO during the search. He has served as a director of Kohls since July of 2019 and was appointed to board chair in May of 2024. Mr. Bender has more than 3 decades of senior leadership experience at prominent retailers, including Walmart, Victoria's Secret, and also iMart Express.
The company also out with some preliminary numbers for the first quarter. Preliminary comp sales down 4 to 4.3%. That is better than the negative 6.3% that was expected. Meanwhile, first quarter loss per share is expected to be 20 to 24 cents. That's also better than the loss of 48 cents per share that was anticipated. We'll bring you updates as they continue to cross. We've got much more ahead on Morning Brief. Now time for some of today's trending tickers. We are watching Tesla, General Motors, and McDonald's. First up, Tesla's board of directors denying reports the EV maker opened a search for a new CEO. In a statement posted on X, the company slammed the report as absolutely false, adding that the board is highly confident in Elon Musk's ability to keep leading the company. Tesla shares have fallen roughly 30% since the year began, and analysts have blamed Doge for taking up too much of Elon Musk's time. The CEO assured investors on Tesla's recent earnings call that he would spend much less time on Doge starting in May. Shares right now are down 0.7%.
Yeah, and obviously we have that denial from the company here. However, of course, they would have this question in the room, given the question mark that investors were obviously putting forward while selling this stock over the last quarter here. Having said that, it's interesting timing coming after a cabinet meeting that happened from the White House on Wednesday. President Trump thanking Elon Musk for his work with the Department of Government Efficiency and saying you are welcome as long as you would like to be here, but then saying, quote, I guess he wants to get back home to his cars. Well, next up, General Motors cutting its full year profit forecast, citing up to $5 billion of exposure to auto tariffs. CEO Mary Barra wrote in a letter to shareholders the company will keep strong dialogue with the administration on trade policy. On Tuesday, President Trump signed an order easing some auto tariffs, though a 25% levy on all vehicles imported into the U.S. is going to remain in place. The guidance here at the start of the year for the company, over $15 billion, now in the $10 to $12.5 billion range, Brad.
Yeah, exactly. And we've been monitoring extremely closely what the reaction from some of the auto manufacturers would be, especially in light of some of the tariffs where they were looking for exemptions. But those exemptions are going to be rolled in, I guess pun fully intended there, over time. And that is going to be a larger kind of implication that we have to watch closely to see how the manufacturers are looking for everything across the OEM and the production of those vehicles, as it's really specifically targeted towards making sure that some of the vehicles or most of the vehicles have the majority of those models actually built out in the U.S. And that's where a lot of the exemptions would actually come into play as well.
Absolutely.
Also, we're tracking McDonald's here this morning. The shares of the Golden Arches, they are under pressure after the fast food chain's same-store U.S. sales slid 3.6% during the first quarter. The year-over-year sales dropped, the worst since the COVID pandemic, as more cautious consumers temper their spending. McDonald's left its full-year guidance unchanged, though, and the CEO said he's confident in the company's ability to navigate tough market conditions. Shares of McDonald's, MCD, down by about 1.9% here pre-market.
We're getting a lot of interesting insight into the health of the consumer through the McDonald's call here. The company talking about the mid-income consumer being hit in this economy. That is something that could potentially weigh on a lot of other names moving forward here. They're also talking about consumers not necessarily coming in for breakfast, maybe cutting back on some of that spend. Again, a narrative of a more cautious consumer. It is interesting to compare it to the likes of Yum Brands that had some strength in its Taco Bell business. Perhaps the pricing power of McDonald's may be overplayed just a bit as consumers are starting to struggle, but again, not struggling too much given the fact that they did reiterate that guidance for the year. Of course, depends whether or not they will be able to meet that moving forward. And you can scan the QR code here on your screen to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, U.S. stocks pushing higher following strong earnings results from Meta and Microsoft, begging the question, is the AI trade so back? Joining us now, Kevin Mahn, Hennion Walsh Asset Management Chief Investment Officer. Kevin, big tech, can it just push away any trade war worries?
Yeah, I still contend that we're just in batting practice of a doubleheader as it relates to the AI revolution. Wow. And we're going to continue to hear more and more validation of that premise. We heard it from Microsoft. We heard it from Meta. We're going to hear it from NVIDIA again. We're going to have to wait another month until they report earnings. But we learned from NVIDIA earlier that they're trying to adjust to this new world order as it relates to tariffs and trade by onshoring the production of their chips. We learned that they're going to invest $500 billion over the next 4 years on U.S. production at TSMC. I happened to be in Phoenix, Arizona last week. I took a tour of the facility out. It's massive in terms of what TSMC's capabilities are on U.S. soil. And I think we're going to hear more and more announcements to that effect. Onshoring the production, the AI revolution continues, but they're going to be much more diplomatic and much more strategic with respect to the way that they spend their money.
You know, that's really interesting, and thanks for letting us know that you were out there, because now I have a question about that.
Yes.
You know, as you're thinking about the billions of dollars that get earmarked by some of these companies, as the Trump administration is saying it's going to roll out the red carpet, essentially, if you make these massive capital promises over multiple years into the U.S. and investing into the U.S., how much of those dollars are just going into other partnerships that already exist in order to ramp up, in this case for NVIDIA, some of the production that otherwise they would have to put picks and shovels on the ground for?
Excellent example. And I'll go back to GM even this morning, going away from AI, what we learned from their CEO in terms of increasing U.S. productions. They're not going to build more plants. They have 50 plants in place already in the United States, and likely they would just ramp up production there to become more efficient as opposed to taking on all the CapEx spend and building new plants. So companies are trying to find their footing now to try and benefit from this, again, new world order as it relates to tariffs and trade.
I wonder if we can stick on NVIDIA for a second here, because Jensen Huang, CEO of NVIDIA, obviously just in Washington, talking about the risks of China being potentially on NVIDIA's own coattails.
Absolutely.
To what extent is that a risk that you want investors to be keeping in mind?
I think we have to appreciate that the AI revolution isn't going to just have one winner. There's going to be multiple winners, but likely there'll be even more losers. So we have to understand the supply chain as it relates to AI infrastructure. It's not just the chips and the semiconductors. It also relates to the data centers, the cooling solutions for those data centers, the power solutions that right now are coming from multi-utilities through the form of natural gas and even nuclear energy. And then it's the end hardware and the software. So I ask all investors, when you're looking for investment opportunities related to AI, don't just consider NVIDIA. Yes, NVIDIA is the hub of the AI ecosystem, but there's so many other companies that stand to benefit from the continued growth of NVIDIA. And look at those supply chains and trying to exploit them.
Are you saying to avoid NVIDIA right now?
No, absolutely not. In fact, it's one of our largest positions at Smart Trust. I think it's a hold. We continue to add to it, but there are also potential benefactors, whether it's TSMC, ASML, you look at the data centers like Digital Realty, you look at the data centers such as Iron Mountain. How about the cooling solutions such as Vertiv? Even if you look at Modine Manufacturing, look at the utility companies, big old boring utility companies that supply the power. DTE Energy, Duke Energy, they have dividend yields above 3%. They have a beta of less than 0.5, which means they're roughly half the volatility of the U.S. stock market, and they're up about 14% year to date. Plenty of opportunities.
As you think about the energy that is required to power the data centers and the footprint of data centers of the future that are going to have so much of the generative AI running through those footprints, is there enough energy to actually power that as is? And does that make something like solar the sleeper pick for the AI trade?
I think it's one of the sleeper picks. In fact, it's estimated by the end of this decade, data centers alone will consume up to 10% of our country's entire electricity grid, a grid that's very fragile right now and prone to failure. So we're going to have to explore alternative power solutions, solar, geothermal, even nuclear, and as we're seeing, these small modular reactors that can power data centers on their own off-grid. So it's going to be a multi-pronged approach, but with that multi-pronged approach, I think there's going to be multiple investment opportunities as well.
And when you think about those investment opportunities, do you think that they outlast any DeepSeek, any tariff issues?
I think they do, because they're very different in complexity, right? DeepSeek is a cheaper version in terms of the true capabilities for those larger machine learning models that require more processing power and larger chips. You're going to have to look beyond that. And that brings in the NVIDIAs, that brings in the Taiwan semiconductors. And of course, in terms of lithography, that brings ASML. So once again, tremendous opportunities as it relates to the AI revolution. We're just getting going, but look to build a diversified portfolio. Don't just try and pick one or two winners.
Kevin, great to see you. Thanks for joining us in studio.
My pleasure. Thank you.
On the other side of the break, we got the opening bell on Wall Street. Stick around. Morning Brief returns soon.
And you are hearing your opening bell on Wall Street for this Thursday morning, looking at live images from the New York Stock Exchange and the NASDAQ here. Really interesting to see what's happening in markets today, given that the big tech names, maybe they're getting their mojo back. It's certainly what we're seeing in the trade this morning. Let's take a look at the major averages here. You are starting to see these major averages pop up on our screen here. You've got your S&P 500 up nearly 1%, actually coming off its highs before the opening bell. Maybe those jobless claims coming in a touch higher than expected, weighing on sentiment just a touch, though. Of course, hey, we'll take a good day after so much volatility. I really quickly want to take a look at some of the sector action here. And when you think about the fact that we have had so much volatility on those tech names, take a look at your XLK up over 2% here. And if I can broaden it out just a touch, take a look over the past month. You can see that we have still had some movement to the upside in some of that tech activity, even though tech has been under so much pressure over the course of the past quarter, given some of the volatility with regards to the trade war. Let's get it over to Yahoo Finance's Jared Blickery for a broader look at what's moving. Hey, Jared.
Well, thank you, Maddie. I'm going to start off by saying NASDAQ really surprised me last month. April was down 12% in the NASDAQ. It closed in the green, and I'll just show you that 1 month chart real quickly. And there you go, 2.02% over the trailing month right now. And then the Dow and the S&P 500 are heading for their first 8-day winning streak since last year. I think it was August for the S&P and September for the Dow. But I want to take a little bit of a longer-term view here in the S&P 500. This is a year-to-date chart, and I've been posting this just about every day. I want to highlight that we are now seemingly comfortably entering this area of price memory that we had way back in March. So really the markets and the traders have to get beyond these levels here and punch above it in order to have a shot at reclaiming those highs. But anything can happen in this area, so there's still a little bit of work to be done. Notwithstanding that, we have a lot of bullish developments here. The VIX is dropping to a 4-week low. This is again a year-to-date chart, and we can see right there, not a big movement today, but I think traders will welcome that sign, still hovering above the 20 level at 24, so some work to be done there. But not a lot happening in bond or dollar land, so I'm going to move on again to the sectors. This is XLK here. That's the tech sector that is leading up 2.21%, the best day in a week, and we are not surprised to see that. Guess who's leading it? That is Microsoft. Microsoft on the upper left there, largest stock in the public universe here on planet Earth. That is up 10% today. NVIDIA up 4%, Meta off of its earnings up 5%. For Microsoft and Meta, these are the best days in 3 weeks. You'd have to go back all the way to that Trump announcement of the tariff detente on April 9th to find a better day. And it's going to be difficult to find a better day than that for a while. Want to point out, too, that software and disruption are leading the tech sphere today. This is my leaders board, and we can see MAGs. At the MAG 7, that's up almost 4%. Then we have Bitcoin also following software. That's a Microsoft play. That's up 2%. And also ARK Investment Fund. Want to point out that I'm going to show my heat map of some of these components here. Tesla just swung into the green. It was in the negative just prior to the market open. And you're seeing a lot of green here in disruption. Not so much we have a lot of green in the semi space, and NVIDIA leading there in Taiwan semi, but a little bit of red. So software and disruption really leading the way there. Notwithstanding all this green, I feel the need to point out a couple things in futures land. We have crude oil that has now hit the second lowest level, $58.12 is where it is right now. It hit 56 and change. That is the lowest level in 4 years. You'd have to go all the way back to about January or February of 2021 to find a lower level. That speaks to the demand picture globally, and I don't know quite what to make of it right now, but that's something I'm definitely going to keep my eyes on. Then I also want to point out that gold and silver, this is a 6-year chart. I'm going to punch this down to an intraday. Gold and silver having their worst day in a couple of weeks there. Is the rally in gold and silver over? By no means. I don't see anything in the technicals here that see extended weakness, but just a little bit of a bad day for the precious metals. And I'll send it back to you guys.
All right, Jared, I'll add one more to you. The best month-to-date performance for Berkshire Hathaway of all time over the course of the last month. Thank you so much, Jared. Let's get to a stock moving at the market open this morning. Eli Lilly here, taking a look at shares down over 7.5% after the company cut its profit outlook, despite topping first quarter estimates as demand for the company's weight loss drugs surged. Yahoo Finance senior health reporter Anjali Kemlani is here now with a closer look at the results. Anj, what do we know?
Yeah, so what's pressuring the stock actually isn't that profit cut. We do know that it came from a slightly higher tax rate for the year that the company announced. They did reaffirm their guidance. I want to point that out. Take a look at the numbers really quickly on your screen, beating those estimates handily. And then let's go into the topic of the day, which is their GLP-1 drugs. When you think about Lilly, of course, we can't miss that. And those also came in ahead of estimates, moderately so. And that's a little bit where the pressure is coming from. Even though Zepbound, that's the weight loss drug, has taken the lead over competitor Novo Nordisk Wegovy, we have seen some concerning news this morning that is possibly the reason for pressuring this stock. And that is a deal between Novo Nordisk and CVS. Those two companies came up with a deal that puts Novo Nordisk Wegovy on CVS's formulary as a preferred weight loss drug and excluding Zepbound. And that comes just as Zepbound took the lead in terms of weekly prescriptions in the recent past. I had a chance to speak to Eli Lilly CEO David Ricks, and he told me that on the news of this deal, the company isn't really looking at it. He said it feels a little bit like last decade. These lockup deals were not interested in exclusive deals. And that's in part because he signaled to me that the company isn't thinking just about these two drugs anymore. They're already moving on to the new generation of the drugs, as well as that pill form. Lilly now in the lead for getting first to market after Pfizer dropped out of the race earlier this month. So that's where his focus is. Meanwhile, I also had a chance to talk about the tariffs and how the company's thinking about that. Both CFO and CEO told me that they're already planning for potential that's already built into the guidance. And specifically, if the goal, quote, is to repatriate the supply chain, I would say probably the threat of tariffs has already done that. Declare victory and move on would be my advice, is what Ricks said. Talking about how, the companies, we've seen a large number of companies announce major moves and major manufacturing commitments to the tune of billions of dollars. Eli Lilly itself announcing $27 billion in additional to take the total number to about $50 billion since 2020. So that's a lot of where the move is coming from. And yet still, despite all these positives, you look on your screen, you can see Lilly sinking right now. We'll have to see if Ricks can talk to investors later today and really get a move on that stock.
Anjali, thanks so much. Breaking these down, some big deals this week that have come forward, especially considering Wegovy just had another one with Hims and Hers earlier.
That's right. They're ramping up their telehealth. Yeah.
Anj, appreciate it. Time now for today's strategy session. In the latest sign of economic trouble, weekly jobless claims surged to 241,000. That's more than expected and pushing bond yields lower. Treasury Secretary Scott Bessent saying shorter-term treasuries like the 2-year are signaling to the Fed that it's time to cut. Joining us now is Brij Khurana, who is the Wellington Management Fixed Income Portfolio Manager. Great to have you here with us in the studio. Okay, so first, let's just start on the comments from Treasury Secretary Bessent, because they have been putting a lot of pressure on the Fed to cut rates right now. From what they're seeing in the 2-year, does that, from your perspective, also signal to the Fed that it's time to cut?
So, whether or not it's time to cut or not, I think the Fed is probably going to be very resistant to cutting in the next few meetings. And so the market's pricing the Fed at about 60% chance of a cut in June. And, I think that's much too high because this is a Fed that we'll remember is data dependent. And the data is going to look pretty good over the next few months because we've front run so much spending from tariffs. And I think the second reason is that, the Fed wants to see the impact that the tariffs are going to have, the immigration policies on growth and inflation. And they think it's going to be lower growth. They think it's going to be higher inflation. And Chair Powell said what you're supposed to do in that situation is focus on where you're further from target. Well, they're a lot further from their inflation target than the employment target. And so point being that I think they're going to actually lean in a more hawkish direction than the market anticipates. Now, to your point, that puts them in conflict with the Trump administration. And I think, maybe an olive branch they could offer to the Treasury is to say, look, we're going to end quantitative tightening completely. We have the debt ceiling getting figured out, but once that gets extended, maybe they could even go back to increasing their balance sheet slightly. So point being that maybe that's like the olive branch that they can offer and say, hey, look, we're not cutting rates as much as you want us to, but at least we're not selling bonds, the way we had been.
I hear you basically saying Fed funds rate, whatever. That's not going to make them cut. Yeah. To what extent is there a potential for a policy mistake in there where we do see the economy rolling over?
Yeah, I think the Fed is in a very tricky situation because their inflation's still above target, and we're dealing with economic policies which do likely represent a worse growth and inflation trade-off. And so, I do think that they would rather make a policy mistake by cutting too late, particularly when they feel like they have a lot of room to bring it down, compared to cutting too early and then reigniting inflation. And I do think, Powell still has a year left. He doesn't want to be known as, this century's Arthur Burns, who cut rates too low and didn't beat inflation in the 70s. And I think his other goal is really to establish Fed independence, at least in his time as Fed chair. And so, I do think that it does set up markets for a contentious relationship between the Fed and Washington, but I think that's what we're going to live for the next year.
And so in the meantime, it's Fed Chair Jay Powell and the FOMC, as Jalen Hurts would say, keeping the main thing, and the main thing for them is this dual mandate of where inflation is at, and making sure that there's price stability, rather.
Correct.
And then additionally, maximum employment. Employment seems to be one of the areas that remains extremely gray here, and no pun intended, but Challenger Gray and Christmas today talking about layoffs for the month of April, hitting the highest tally for the month in 5 years, and directly pointing out some of the effects of Doge as well within that.
Yeah.
So what should the Fed be looking for in their cues within the employment situation data, especially knowing how much of it is actually self-induced because of the cuts that were rolled forward by Doge?
Yeah, I think it's a great point. If we look, we get non-farm payrolls tomorrow, so that's their most important data point that they look for. But, if we think about where the job gains have come since the end of 2022, basically half of them have come from three sectors: the government, healthcare, and education. All three in some ways are under fire in the administration and because of Doge. And so, if we look at private sector job growth, it has not been quite strong. I do think that we have the potential. Now, when are those cuts likely to materialize? Talking to some of our analysts, a lot of the local government spending cuts will take place on the employment side after July. So once again, we're in this very tricky window where, to your comment, Madison, I think the Fed could be behind the curve because data is going to be strong. The labor market could look okay for the next few months, and inflation could be higher. And so we're setting up for an environment where the Fed could be behind the curve, and you get this conflict with the administration. So, buckle your seatbelts.
Rich, great to see you. Thanks so much for taking
Thanks so
time
much.
in the studio.
Appreciate it.
As we head to break, let's get a check-in on shares of Microsoft. At the open, you're seeing MSFT surging by more than 9% following the company's strong earnings results. The company also announcing it's raising prices on Xbox consoles, games, and accessories. They say that some new Xbox games will be as much as $80 for the holidays. That's not good news for Madison and all of your gaming habits.
I'm a big Xbox girl.
Huge Xbox.
Look at me, the poster child for Xbox.
We've got much more ahead on Morning Brief, everyone.
Shares of CVS really popping here after beating Wall Street's expectations on the top and bottom lines in the first quarter. The shares up over 7%. CVS shaking off concerns about Medicare Advantage costs prompted by disappointing results from United Health. CVS also raising its full-year outlook for both adjusted earnings and revenue. For more on this, I want to bring in Brian Tanquilut. He is Jefferies Healthcare Services Equity Research Analyst. Brian, a very different tone to come into my conversation with you than recent quarters where we've gotten to chat about CVS. To what extent do you think that this is a new day for the company?
Hey, Madison, thanks for having me and good morning. Yeah, so it is a new day, right? It's nice to see that margins came in good, especially in that Aetna Medicare Advantage business. That's been kind of like the problem child of the last year. So I think a lot of the things that we chatted about last year, the things that CVS, the levers that they were pulling, are finally kicking in. So whether that's exiting certain parts of the market, and then the bonus payments that they're getting from Medicare for 2025, they're all working together, and that drove a pretty good margin beat in that Aetna side of the business. And then the pharmacy did pretty well as well, at least on the true pharmacy side of the business, and then the PBM did as well. So it feels like things are finally clicking for CVS, and we're starting to see trends kind of stabilize across the business line.
Okay, so with that stabilization, Brian, for the stock at the levels we're seeing it trade at, does that make it more appetizing for investors who are looking to layer in more of kind of the PBM business back into their portfolio?
Yeah, Brad, thanks for that question. So the way I'm thinking about it is that, look, I think number one, the stabilization is a good sign for investors that we're more cautious thinking about the trends here, right? Like, especially as Madison mentioned earlier, United had a bad print coming into today's release from CVS. So seeing that CVS is seeing a trend that is more stable or stronger than some of its peers, and then obviously the diversification of its business, I think this is where investors can step in and say, okay, I have the confidence that we're just going to get better from here. Management adjusted some guidance ranges here. It looks like there's still conservatism in their projections for 2025. So we feel really good about this. And then the other side of this is, I think, the defensibility of this business, right? It's a drug business, it's an insurance business that obviously has heavy Medicare exposure. So at a time when we're looking at macro volatility, macro concerns, I think as things stabilize for CVS, it becomes even more compelling.
And I do want to talk about the weight loss drug elephant in the room. CVS saying its drug benefits unit did negotiate a deal to make Novo's Wegovy more widely available to its members. Do you think that this is setting a tone that others in the industry may follow?
I think so. I was watching the earlier part of your show, right? So what we're seeing is that these PBMs are starting to flex their market power. They're starting to use the fact that supply is starting to improve across the GLP landscape. And then there are obviously other drugs coming down the pike in the GLP world. So I think what we're seeing is that this is your typical PBM playbook where they're trying to pit different players and trying to put them in formularies that eventually benefit their members, that benefit the plan sponsors that are their clients, right? So I think we're seeing that. And I think, heading into this year, the market dynamic in GLPs made it difficult for the PBMs to really function in that specific therapy class. And now we're seeing it. So I think you're going to see more of this.
What's CVS telling you about the state of the consumer right now, Brian? As you have a lot of households that are just leaning into what they need. And unfortunately, the pharmacy and that part of the business is certainly what they need on an ongoing basis. But the other elements of the business that might have a little bit of pushback that's occurring.
Brad, if you think about the front end same store sales for the retail box, right, it was negative this quarter. So I think it shows you that there are pressures that are still persistent for the consumer, inflation, consumer confidence, all these things, right? But on the pharmacy side of the business, within the box, those numbers actually look really good. So I think what it's showing you is that the pharmacy is proving to be defensive. People are still taking their medications. They're still going to their doctors. It's just on all of the discretionary things is where they're pulling back. So the purchases that are, impulse purchases when you're waiting for your medications to be filled at the pharmacy, I think that's where people are trying to rein in a little bit.
And are you concerned at all about any policy change from the Trump administration negatively impacting some of the positive sentiment today?
Yeah, we're watching what tariffs would do to retail first, right? The front end of the store, obviously, there are things that they buy from overseas. They made it sound like it's not a lot, like a lot of their purchases are actually from U.S.-based companies. So we'll see what the flow-through impact of tariffs will be on that. And then obviously the pharma tariffs that are being contemplated right now, although I think most of that will be passed through. And then the broad thing that we're watching is just what happens with, what's going on in Congress right now with the tax bill that they're trying to fund with cuts to healthcare, right? So I think that will have an impact on insurers eventually, especially those that are exposed to Medicaid, not much to CVS. But those are the things that we're watching for as it relates to like policy and regulation and politics.
Brian, thanks so much for taking the time. Great to see you.
Thank you.
Coming up, details on a new minerals deal between the U.S. and Ukraine when we return. The U.S. and Ukraine have signed a critical minerals deal after months of negotiations. The agreement gives the U.S. access to Kiev's mineral resources in exchange for U.S. investment fund in Ukraine. Here with the details, we've got Yahoo Finance senior markets reporter Inez Ferrer. Inez, what do we know on this?
Yeah, Brad, well, the optics of this deal so very different than back in March. So we had with this deal Treasury Secretary Scott Bessent signing it along with Ukraine's deputy minister. Much different than back in early March, when you had that meeting between President Zelensky of Ukraine, President Trump, and Vice President J.D. Vance, that meeting which went sideways. Look, President Trump has long said that he wants the U.S. to be reimbursed for the support that it has given Ukraine during the war. So this deal will involve setting up what's called a reconstruction investment fund. The Ukraine and the U.S. would jointly manage and maintain the fund. And just to back up a minute, when we talk about critical minerals, there are more than 50 critical minerals out there that are used in modern technology. A subset of these minerals are what are called rare earth minerals. Think nickel, think lithium. These rare earth minerals are used in things like magnets that go into EVs, they go into electrical grids, they go into weaponry. And Ukraine has over 20 critical minerals. They have about 5% of the world's deposit on critical minerals. And why is this important for the U.S.? Well, this circles back to China, because China controls most of the critical minerals processing, most of the reserves. The U.S. is almost 100%, very, very reliant on China when it comes to critical minerals, according to the sources that I've talked to. And China accounts for 60% of those global reserves. Beijing has been tightening its controls on exports of critical minerals to the U.S. in retaliation for the tariff policy that is going on right now. The U.S. produces some critical minerals. It produces aluminum, it produces zinc, magnesium, but others it definitely needs. What are some of the challenges when it comes to this? Well, look, Russia controls a large part of the eastern part of Ukraine, where you have a lot of deposits there. You've got a lot of coal coming out of there, also lithium. So that would, if Russia keeps that, then that would not be included, obviously, in this deal. So as far as the mines are concerned, it takes more than 15 years for these mines to be operating, between the time that you identify it and the time that you pull it out of the ground. So these are years and years and years of development when it comes to taking these deposits out of the ground.
Absolutely. Inez, thanks so much for taking the time, breaking this down for us here this morning. That does it for the morning brief. Join Madison in the next hour for Catalysts, and then 11 a.m. Eastern Time, we've got, well, stick around.